what's the difference between a down payment and closing costs? That's what we're going to be going over in this video. And, before we get into that, some of the other things that we're going to be covering, on the down payment side, what's the minimum down payment you need to make? Because there are, some loans that require almost nothing down, and there are some loans that are going to require a lot more down. So we're going to be going over all those kind of things. And then when it comes to closing costs, we're going to go over what exactly are closing costs. And you may or may not know that it's actually sometimes possible not to even have to pay any closing costs. So we're going to go over those items, and also things like, is it possible, for example, to get a gift to help pay for your down payment, maybe from your parents or something like that. Also in this video, this is all for your information. I'm not working on behalf of a lender or getting any benefit from this video whatsoever. So this is all just for your information and for your benefit. So if you like what you hear and the information is useful, do me a favor, hit the like button or hit the subscribe button. And even more important, please make a comment. Maybe during the course of this video you have a question, you're not sure about something, please let me know, and I'll try to make a video just for that question. So let's get into talking about down payments and closing costs. And just before we do that, my name's Charles Courtney. I work in the Las Vegas real estate market. And with that in mind, it's currently 2023, and the current average price, the median price for a home in Las Vegas is around $400,000. Of course, you might be paying less if you're buying a condo, or you might be paying more, but we're going to use that figure throughout this video just as an example. So with a $400,000 home, how much of a down payment are you going to be required to put down? So that's the first thing we're going to look at. So the first thing to dive into is there's basically, we're going to look at 4 different ways that you could purchase a home, and each one of those ways that you purchase the home will reflect a different amount of down payment. So what do I mean by 4 different ways? Well, essentially we're talking about 4 different kinds of financing. And so we're going to look at firstly FHA, an FHA loan, we're going to look at a conventional loan, a VA loan, and also a cash purchase. So let's jump into first FHA loan. This is a great program that's a government-backed loan by HUD, through HUD. And, even though technically, it's really good for first-time home buyers, anyone can actually use this program, whether you're a first-time home buyer or not. And the great thing about an FHA program is it is really good for people who maybe are struggling with their credit score. The first thing to talk about financing is the better your credit score, the less down payment you can actually put down. So generally 620 is a number that you need to remember. 620 credit score is kind of like the borderline between getting a conventional loan and not getting a conventional loan. So if you want to get a conventional loan, which often has a lower interest rate possibly, you're going to have a pretty good credit score of 620 or above. What if you don't? Well, that's where an FHA program, the government-backed loan, can really be helpful and come into play. So let's look at that first. If you have a credit score under 620 and it's above 500, you can apply for an FHA loan. And if your credit score is around 580 to 620, you can put as low as 3.5% down. If your credit score is between 500 and 580, you're going to actually have to put a little more down. You're going to have to put 10% down. So what does that mean? Let's do the maths real quickly. So the easiest way to do that is in the example of an FHA loan. Let's say your credit score is in between 580 and 620. You need to put 3.5% down as a down payment. Well, what that means is, the easiest way to do that is to go in 100,000 blocks. So what's 3.5% of 100,000 is 3,500. So we're going to multiply that by 4. That gives us a total of $14,000. So if you wanted to buy a $400,000 house with an FHA loan, putting 3.5% down, you're going to have to come up with a down payment of $14,000. Now let's go to the other side of an FHA loan. Let's say your credit score is between 500 and 580. You're going to have to put 10% down, and that's a much easier equation. So 10% of $400,000 is $40,000. So in that case, you're going to have to put $40,000, or in the case of a higher credit score, you're going to have to put $14,000 down. So that's the basics of an FHA loan down payment. And let's go to another loan program, which is called a conventional loan. That's not a government-backed loan. And, a lot of people use that, especially if you have a credit score that's above 620. That's a good option to use, because in that case, you can put as little as 3% down. So what's 3% of 400,000? That's an easy equation. That's going to come out to 3,000 times 4. That's going to be $12,000. So you're going to have to put a $12,000 down payment on a $400,000 house with a conventional loan, putting 3% down. Now the thing about conventional loans is, that's the minimum, but some people will use an option of going for more, like a 5% down, 10% down, even as much as 20% down. And if you're actually buying a home for an investment property, you're actually required to put 20 to 25% down. Now you might be saying, well, why should I put 20% down or 10% down when I can just put 3% down? And in the case of looking between an FHA loan and a conventional loan, you might be saying, well, why would I put 3.5% down in an FHA loan when I can put 3% down in a conventional loan? They're good questions. The answer to the first question is, it depends on your credit score. If your credit score is under 620, you're not really going to have an option to get a conventional loan, because you're not going to be approved for a conventional loan. So in that case, an FHA loan with 3.5% down is a really good option. But let's now move back to the conventional loan. So with a conventional loan, why would you put more than 3% down? Well, this is a really interesting thing about down payments is, and we'll go over, 3% down would be $12,000. A 5% down would be $20,000. 10% down would be $40,000, and 20% down would be $80,000. So why would you want to put $80,000 down on a $400,000 property in a conventional loan when you could put just 3% down, which is $12,000? Well, the answer to that question is interesting, because if you can, and not everyone can do that, of course, but if you can, it's actually to your advantage. One reason is, just do the math. So if you put $80,000 down, which is a 20% deposit down on a home, that means you only owe $320,000 left to pay in your loan. So your monthly mortgage payment, therefore, will be less than if you put $12,000 down, and in that case, you're going to owe $388,000 on the loan. So it's just basic maths. The more that you put down, firstly, you have more equity in the home, and secondly, your monthly mortgage payment is going to be lower. So they're really big advantages, and that's why people do that. So that's a conventional loan and down payments. Now, what about the third option, a VA loan? A VA loan, you can put 0% down. And so now you're probably saying, well, let's sign me up for that. How do I get qualified for that? A VA loan is funded by the Veteran Affairs. It's a government-backed loan again, and you have to have had some kind of military service. So, it's usually at least a minimum of 90 days active service, or 2 years, of non-active, or, there's different requirements like that. So if that fits the bill and you are a veteran, that's a great option. 0% down, 100% financing. Obviously that means for a $400,000 house, you're going to be putting $0 down as your down payment. Of course, as I mentioned before, if you can put something down and put some equity in the house, that's a good option, because you lower your monthly mortgage payment that way. Okay, now finally, another option is all cash. Now, of course, a lot of first-time home buyers aren't in a situation where they can put all cash down, but some are, or some people, maybe they're not a first-time home buyer. Maybe you have a home that you've sold and you've cashed that out and you're flush with cash and you want to buy another home. Maybe you're downsizing, for example, or maybe you're needing to upsize. Maybe you're selling a home and you want to get an extra space because you have, a new addition to the family or something of that nature. In that case, you might have the cash to actually purchase the home completely. That's a great option. In that sense, you really don't have a down payment because you're paying everything up front. You're going to give the full amount of the $400,000 at the closing of the contract. So in that sense, you don't really have a down payment at all. You might have an earnest money deposit, but we're going to get into that in just a second. So they're the four basic options you have for down payments. Let's jump quickly into closing costs. We talked about down payments. Now, what's the difference between a down payment and closing costs? Well, closing costs, to understand what they are, let's briefly go over how we actually close a transaction, then it becomes kind of self-explanatory. So in order to close a transaction to buy a house, if you're using a lender, for example, there's going to be a lot of people involved in making the transaction happen. So for example, you're going to go to a lender, they're going to approve you, they're going to finance, to get your loan approved. They're going to be doing a bunch of work on your behalf in order to pre-approve you, to get the loan, started, and then to actually transfer the money and do all that business. Well, they need to be paid for their services. So when you close, part of closing costs are lender fees. You're going to be paying lender fees for their services. Similarly, another part of closing is doing a title search and also getting title insurance. Basically, what that is, let's say when you buy the property, basically what happens is the title gets transferred from the seller to you as the buyer. And what you want to be sure of is no one else can come in and say, hey, this property really belongs to me. So title insurance insures you against such a claim, and you, of course, are then going to have to pay for that. So part of closing is paying for the title search and also paying for that title insurance. Those are title fees. Then there are also fees for escrow. Escrow we're going to go into in just a minute, but you're going to have to, when you go through a transaction, you don't give your money, say your initial down payment, you don't give that to the seller directly. You give that to a third-party neutral company called an escrow company. They're a third party. They hold on to your cash for the purpose of the transaction. Maybe the transaction doesn't close, then they give you the money back. So you're going to use an escrow company for those services. Then in addition to those, in addition to the lender fees, the title fees, and the escrow fees, you also have what are called prepaid costs. Prepaid costs are things like when you buy a home, you're going to have to pay taxes, you're going to have to pay home insurance, and you're going to have to pay interest on the loan if you're using financing of that sort. So what they do is you have to actually prepay some of those ahead of time. So, and they basically use the calendar year. So let's say there's a few months left in the calendar year, you close the transaction. In order to close the transaction, you're going to have to prepay, a few months normally. You're going to have to prepay your mortgage interest. You're going to have to prepay the taxes that are going to be due on the home, and you're going to have to prepay the interest and home insurance. So that's a big part of closing costs, those prepaid costs. The technical word is impounded. So they impound a certain amount of money. So when you buy the home, you've already got money ready to pay your taxes, pay your insurance, and pay your interest on the loan. That's another part of closing costs. So an easy, generally way to calculate your closing costs, it's usually around 3% of the purchase price. So let's go back to our example. We're going a $400,000 purchase price. 3% of that is $12,000. So when you close, you're going to have to, let's use the example of a conventional loan. You're putting 3% down, and you also have closing costs in addition to that 3% down. So the 3% down payment is $12,000. The closing cost is another 3%, that's another $12,000. So you add those together, your total closing cost is going to be $24,000. So that's basically, what the difference between a down payment and closing. One final thing to mention is it possible in the down payment to get a gift or closing costs, from a parent, or use money from an IRA or something of that nature? And yes, it is. In order to do that, you're going to have to show, a paper trail, like, you're going to have to show the bank account where the money is. For example, in your parents' bank account, it's going to have to be transferred to yours. You're just going to have to show the proof of funds that they exist, and you're going to be using them for either your down payment or closing costs. And another great thing is, especially in a market like today where it's becoming a buyer's market, and what that means is there are a lot of homes for sale, but there's a lot more sellers out there, then now there are buyers because federal interest rates have gone up, which means mortgage rates have gone up, which means there's less people who want to buy because of the high mortgage interest rates. So that means there's less buyers for each seller. So sellers want to make, their home more attractive. And one way that can often happen is if you're working with a real estate agent, they might say to you, which I had a client recently who insisted on this, is that you ask that the seller will contribute to your closing costs. So we went over the closing costs, the prepaid costs, the lender fees, the escrow fees, the title fees. And sometimes people will say, I want the seller to contribute, for example, $10,000 towards my closing costs. And in a market like today, people are often willing to do that. How that works is, let's say you go through and the property sells and the money is exchanged. Well, when the seller, he doesn't get the full $400,000, the first thing that's going to happen there is that $10,000 is going to be taken off that $400,000 to pay for your closing costs. So then he would only have $390, and then there'd be other fees such as broker fees he's going to have to pay as well. So that's another thing to mention about closing costs. It is possible in some situations not to have to pay any closing costs. And then another thing to mention is the down payment. So when you first start what's called escrow, you get an offer accepted, and then what happens is, to start the whole process of closing, you as a buyer, you're required to, you can think of it as you put your down payment in 2 installments. And the first installment is called an earnest money deposit, and that's at the beginning of escrow. So after you get an offer accepted, it's usually about 1% of the purchase price. Let's say it's $3,000 or $5,000. So let's say you put $5,000. It's like, think of it as the first installment of your down payment. You have to do that straight away, and after that is done, then you go to the next stage of closing. Now, when you go through your inspection and everything else, and you get to the final stage of closing, you've already put $5,000 down. Let's say you're putting a $12,000 deposit down. That's 3% on a conventional loan. You've already put $5,000 down in your earnest money deposit. When you get to the final closing, you only need to bring another $7,000 to finish putting your down payment down. So think of it as in 2 installments. So that's very common. That's usually how most transactions work. You think of your down payment as in 2 installments. So that's just another thing to mention, because you're going to hear about an earnest money deposit, and you might have a question, well, is that part of my down payment? And yes, it is. You can think of it as that way. So I hope that's been helpful. There's a lot of other things we can discuss, and if you have any questions about the whole closing process in general, check the link above. I go over all the different aspects of closing from start to finish in the video that's above. And also, again, if anything in this video was useful or helpful for you, please hit the like button, subscribe, and do make a comment. If you have a question about something, I'd love to make another video just to answer that question. And stay tuned for the next video, and thanks for watching.